The fascinating thing about running a Substack is you do get a feel for, if you like, the sort of the public's attitude, and particularly the Western public's attitude towards gold. They just haven't bought it. They don't understand it. And the key to it is that they don't understand the difference between money, legal money, which is gold, and credit, which includes currencies. You can't blame them really, because we have had, 50 odd years of propaganda from the US Treasury that, the dollar is the new money and gold is out of the system. There is a huge education job to be done. I think, unfortunately, events are now beginning to overtake any education process that I don't really concern myself too much with the price of gold for the reasons that I've stated, that actually what we're looking at is not gold going up, it's currencies going down.
Gold has regained significant attention among central banks globally, with many institutions increasing their gold reserves. This shift was notably accelerated by Russia's invasion of Ukraine in 2022, which sparked geopolitical uncertainty and concerns about the stability of the global financial system. Initially, nations like China and Russia led the charge in diversifying away from the US dollar and its central role in international finance. However, this trend has expanded beyond these countries, as central banks worldwide now seek to mitigate risks by diversifying their assets. The recent surge in central bank gold purchases signals a deeper shift in monetary policy, rooted in historical patterns of gold as a safe asset. According to Alasdair Macleod, a financial expert and commentator, the growing shift in global financial strategies is being driven by concerns over the unsustainable fiscal practices of major economies, particularly the United States. With the U.S. projected to exceed $3 trillion in deficits this year, alongside soaring interest rates and rising debt servicing costs, the dollar faces immense pressure. This shift in sentiment raises concerns about a potential collapse of the fiat currency system unless significant policy changes are enacted. Meanwhile, Alasdair Macleod highlights that the perception of gold in the West has evolved significantly over the years. Historically viewed as a speculative asset, gold's intrinsic value as a hedge against economic uncertainty and inflation becomes more apparent as trust in fiat currencies wanes. Unlike fiat currencies, which have faced volatility and decline, gold's purchasing power has remained remarkably steady over centuries. As the global economy faces increasing instability, gold may no longer be just a hedge against inflation, but could become the foundation for a new monetary system. If confidence in fiat currencies continues to deteriorate, gold could emerge as the cornerstone of a new global financial order, challenging existing financial paradigms and reshaping the future of international trade and investment. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
Gold has been basically bought by Asians and central banks. So the central banks, I think, are clearly signaling that there's something wrong with the world of fiat. But the population, investors, have been ignoring it in the West. You just look at the mining shares and all the rest of it. There's very little interest in it. Okay, they've recovered somewhat, but they're nowhere near the potential that the sector has. And as far as gold is concerned, really, it's yet to be bought by the West. It's only, a couple of months ago that the ETFs, physically backed ETFs, started sort of, instead of being sold off, started recovering a bit. The fascinating thing about running a Substack is you do get a feel for, if you like, the sort of the public's attitude, and particularly the Western public's attitude towards gold. They just haven't bought it. They don't understand it. And the key to it is that they don't understand the difference between money, legal money, which is gold, and credit, which includes currencies. And you can't blame them really, because we have had, 50 odd years of propaganda from the US Treasury that the dollar is the new money and gold is out of the system. So there is a huge education job to be done. And I think, unfortunately, events are now beginning to overtake any education process that I can inject into things. So as to your point about gold beginning to reflect the risks, if you like, in credit, that is undoubtedly true. But this hasn't been driven by the users of the credit. It's more been driven by central banks And also geopolitics, really, to a degree. I think that's probably the best way to describe the Asian demand going on in the markets. That's important. So I look particularly at the moment at the way in which government debt is piling up, and virtually all the G7 governments, with the single exception of Germany, are in debt traps. And there is absolutely no willingness on the politicians' side to actually deal with this. As far as they're concerned, continue to spend. We have got these projects. We have got these, these voters to satisfy, whatever. And they actually just don't give much of a damn for the deficit. I think in the UK, the Treasury actually is trying to impose some sort of discipline on the situation, which makes an awful lot of sense. But they're going about it the wrong way. They're going about it by enhancing the public sector and destroying the private sector. And it's the private sector, basically, that pays the taxes at the end of the day. When the establishment gets it right, it only gets it half right. I mean, look at France. The French government has found it impossible to curtail their deficit. I think they're heading for a 7% deficit this year. If you look at the USA, the deficit there, I think, is going to be greater. I mean, funnily enough, we just had the first 2 months deficit figures for the current fiscal year, because their fiscal year starts on October the 1st. So October and November, something like 690 billion. I mean, it is an absolute all-time record. We're heading for a 3 trillion deficit there. And the point about it, I mean, you mentioned that word inflation. The point about it is that it's deficits which drive inflation, as well, of course, as drawdowns in savings and spending financed by credit. So, the inflation game isn't over. So, that is another aspect which I really look at very, very closely when it comes to trying to assess the outlook for gold. A lot of this, it's not just a sort of monetary approach. I mean, obviously, if you print more money, you're going to dilute the purchasing power of that money. But there are offsets, if you like. So it's not an automatic thing. But I think a point which nobody really understands is that with the fiat currency only stands by the faith that its users have in it. And it's that's now being eroded. And particularly, if you look in the case of the dollar, foreigners own something like $32 trillion worth of dollars and underlying dollar-denominated financial assets. I'm not including any sort of physical stuff in this. They're now being asked to, stump up yet more at a time when, global trade is actually diminishing. It's diminishing because of, tariff policies. And we can see what Trump is going to do. He's going to destroy the world economy with Smoot-Hawley Mark II. And it's worse than Smoot-Hawley Mark I, because Smoot-Hawley Mark I, okay, the Americans were importing things like, foodstuffs and so on and so forth, which was, a real problem for the farmers. But when they introduced those tariffs, suddenly, not only was it a huge expense on consumers, on producers in America, but also you had tit for tat tariffs going the other way, and the world just went into depression. The effect on the budget deficit is tax revenues will be considerably less than anybody expects, and welfare expenses will be far higher. So I think we're looking at a deficit for the current fiscal year in America of over 3 trillion. I mean, I would not be surprised to see that at all. And that, of course, is destructive for the dollar, and it's in a debt trap. I think the point about it, which again, very few people just don't understand, is that when you get risk in credit, interest rates rise. The cost of funding it rises. I mean, we saw this in the UK in 1976 when we had the medium-dated gilts were issued with 15% plus coupons. That's actually where we're headed unless someone does something about it. And that really does mean the collapse of the fiat currency system. The idea that gold is forecasting this. I don't think it's quite right. I don't think we're not at that point at all. And also, people are looking at it the wrong way around in the West. They regard gold as as an asset which you either buy, you buy if it's going up and you sell if it's going down. But the reality is that what's happening is it's not gold going up. I mean, if you look at the purchasing power of gold over millennia, it's more or less held steady. Therefore, it's actually currencies going down, and that's the way to look at it. And when people actually realize that prices are not rising, but their currency is going down, then the currency is doomed. And I wouldn't rule that development out in the foreseeable future, in the next 1 or 2 years. I mean, obviously, I hope it doesn't happen, but I can't see how they can get off this course unless there's a radical change in political thinking.
Following the imposition of currency sanctions on Russia, the foreign exchange market for the ruble has become highly limited, making its exchange rate a less reliable indicator of the nation's true economic condition. Alasdair Macleod argues that this limitation allows critics to claim that Russia's economy is struggling, with the falling exchange rate often perceived as a sign of underlying weakness. However, this view can become a self-fulfilling prophecy, as analysts interpreting the exchange rate decline will naturally seek fundamental reasons to justify it. Macleod highlights that despite these challenges, Russia's economy is far from dire straits. The ongoing war effort requires the state to redirect economic resources from the private sector, leading to labor shortages and increasing raw material prices. Meanwhile, China's growing economic influence is evident in its efforts to diversify away from the US dollar and strengthen its ties to gold. As Macleod points out, China continues accumulating substantial gold reserves, positioning itself as a key player in the global transition toward a new monetary system designed to reduce dependence on increasingly unstable fiat currencies. This shift, along with initiatives like the Belt and Road, signals China's ambition to lead the transition away from fiat currencies, which are increasingly seen as unstable. Similarly, Russia is strengthening its economy with sound fiscal policies and rising gold reserves, positioning both nations to challenge the US dollar's dominance in global trade and finance, offering an alternative to the instability plaguing Western financial systems.
The whole world works on credit. People just don't understand this. And it's this credit which, unless you actually tie it to money in terms of its value, has the risk of losing all its credibility. And that is broadly the situation we're getting into. I mean, if you look at going back to the debt bubbles that governments are in, I mean, we can see that US debt to GDP is around about 130, 135%. Now, what happens if I'm right and we're in Smoot-Hawley 2 or about to go into Smoot-Hawley 2, then GDP is going to go down, okay? The purchasing power of each unit of GDP is also going down, but GDP goes down. And so what does that do to the ratio? Immediately, you're looking at 150% debt to GDP, government. So it's not just the amount of debt, it's also what's happening to GDP. We can see how deficits are going to continue. We can see how not only America, but you've got Britain, you've got France, you've got Japan, you've got Italy, you've got Spain, all the sort of G7, with the exception of Germany, who's got other problems, is in a debt trap. And falling GDP is going to make it considerably worse. And this is going to impinge on the purchasing power of these currencies, which are not attached to anything. I mean, the whole point about a gold standard was that, you attach the value of credit to gold so that the only risk in the credit is the counterparty risk that you have and the time preference risk, loans of any duration. So this is an extremely important point to realize. The credit system we have is not anchored to anything. It is therefore highly vulnerable to the sort of problems which we now face. And by vulnerable, I mean in terms of its purchasing power. I can't see any solution to this unless there is an extremely radical change. There is actually, I mean, you asked a question a little while ago about is there any hope sort of thing. Buy gold, obviously, which means selling credit, incidentally. You're not buying gold, you're getting the hell out of credit. But the other thing is that contrary to Western propaganda, the Russian and Chinese economies are actually in reasonable nick. I mean, particularly the Russian one is extraordinary. They've got 21% interest rates. That's the overnight rate at the Central Bank of Russia. But what they're finding is that the commercial banks are offering deposit rates of something like 18%. What's happening is that the high wage awards, because there's a shortage of labor, a huge demand for skilled labor in Russia. Anyone with a skill has been getting pay rises of 20% plus, and in some cases they've doubled over the last couple of years. So the result is that the rate of inflation is nowhere near the rate of wage inflation. It's running currently at about 8%, 8.5%. I understand from other analysts who sort of look at these things a lot more closely that the rate of inflation is likely to rise, but that's a sort of effect, if you like, of numbers dropping out of the back end, all that sort of statistical malarkey. But look at Russia. Do you know what the income tax rate there is? 13%, flat rate. It does go up to 15% if you're a high earner. Corporation tax, I think, is around about 25%, which is sort of normal. And the debt to GDP, that's currently less than 20%. It was forecast to be over something like 22% this year. But amazingly, Putin's government has managed to run a slight surplus on the budget, despite all the war spending. The Russian economy actually is in pretty good shape. It could go onto a gold standard tomorrow. And indeed, I would suggest that the best thing it could do is go onto a gold standard at current rates. And particularly when you look at the relationship between gold and oil being, the principal export, if you like. The average price of oil since the 1950s, measured in gold, is roughly 30-40% above the current level of gold. This reflects, if you like, the fact that gold is rising or appearing to rise because of monetary effects, whereas this is not the case in commodities. They've yet to catch up. But gold, over a long period of time, it is a broad representation, if you like, of the commodity complex. So, this is a very good chance for Putin to go onto a gold standard. But I think the reason he doesn't is because the Chinese don't want to do it yet. I think they realize that they're going to have to do it at some stage. India, throws up its hands at the thought of this. And they've yet to really sort out the whole of the Shanghai Cooperation Organization and BRICS complex in terms of monetary affairs. They're very much in a sort of intermediate situation. But we do know that China has got very substantial gold reserves in the government, not just in the central bank, but also in wealth funds, and also the People's Liberation Army is a very large holder. We also know that Russian wealth funds have also got gold. So the Russians have probably got about 12,000 tons. They can go onto gold standards tomorrow. But the reason that they won't is that they would immediately demolish the entire fiat currency system around the world by comparison. I mean, it would really be as simple as that. So I think it's the sort of deliberate act which would be just short of a nuclear war. But at some stage, Peter, they're going to protect themselves from a collapse in the purchasing power of the dollar. And so that is, I think, what is going to drive them to protect their own currencies by putting them on gold standards.
In 2025, gold demand is predicted to moderate after experiencing significant growth in demand and prices, which recently surged past the $2,750 mark. This surge has largely been driven by central bank purchases and gold's status as a safe haven asset. According to the World Gold Council, while the outlook for gold remains positive, it faces a combination of challenges and opportunities. The price of gold is expected to rise modestly in 2025, influenced by central bank actions, geopolitical tensions, and economic conditions in major markets such as the US, China, and India. Although lower interest rates and geopolitical risks could push prices higher, rising rates and slowing global growth may act as headwinds. Central bank buying is expected to continue providing support, but the potential for a stronger than anticipated demand or economic disruptions could lead to unexpected price increases. Please share your thoughts on Alasdair's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.